and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. Another roller coaster day for the markets, even if in a tight range, with each of the major indices managing to sneak into positive territory just before the bell. Maybe a kiddie roller coaster, with the S&P 500 notching a fresh record high. We'll dive into the rest of today's market trends as well. Then, if you're trying to figure out what the Fed will do next, should you be ignoring what the central bank actually says? We'll explain. Plus, as Elon Musk's DOGE works its way through the federal government, what impact will thousands of cuts to the workforce have? We'll speak with a former congressman. Well, according to Fed meeting minutes released today, Federal Reserve officials in January agreed that they would need to see inflation come down more before lowering interest rates further, and expressed concerns about the impact that President Trump's tariffs would have in making that happen. Our next guest, though, says if you're trying to figure out what the Fed will do next, pay attention to the data, not those individual comments necessarily. Joining us now, Jerome Schneider, PIMCO head of short-term portfolio management, here with us in the studio. Thanks for being here.
Hey, good afternoon.
So when we, obviously we obsess over Fed speak. It's what we do as people who watch the markets, right? But the Fed itself says we're watching the data. So does that mean we should sort of put the commentary to the side and also watch the data?
Yeah, the commentary from the individual Fed speakers can be elusive at times. And what we're thinking about in this current environment is sort of the intersection of data that comes forward from growth, data which comes from inflation. And really, that prescription was made clear today by the Fed minutes, where they're going to sort of take a pause, see where the economy evolves, and more importantly, what happens to the monetary policy in the medium term. So individual comments, while important to sort of get a flavor for the ingredients that the Fed's considering, won't necessarily lead to an output. It won't necessarily be a baked cake in the near term. We need to be thinking about where the Fed's going to do, and quite clearly, they're going to be relying upon the optionality of simply having a Fed statement, having Fed minutes, which gives them that optionality over that medium term.
Right, and it's effectively what they're saying is they don't know what effect all of the fiscal policy coming down the pike is going to have on inflation. And so if they're waiting, we kind of have to wait on that front as well.
Investors, the Fed, a lot of participants would like a crystal ball to say, here's where the destination is. And quite honestly, it might take some time for us to get to that destination. The reality is that fiscal policy is something that's going to be contended with in the short term. We're clearly seeing the administration go after some areas in that regard. But longer term, we're still waiting to see the effects on the fiscal outlook longer term. And there's going to be some points of interest on this in several regards. Number one, the fiscal policy with regard to revenue increasing. Tariffs obviously is an income to that balance sheet. On the second hand, if it comes into consideration later on this year, tax cuts obviously a negative. And how it all comes to fruition, the timing may not exactly be so prescriptive, so precise that we'll simply say the Fed's going to need to ease or perhaps even raise rates in the future should inflation be stickier. So for investors, we find ourselves at a very unique point in time. Risk assets are nearly priced for perfection, especially when you look at equity risk premiums. Second thing to look at is if you look at the forward rate expectations, the dividend expectations for equities, for the first time in a few years, they're actually lower than bond yields. And that puts us in a very interesting environment where perhaps taking additional risk in the form of equity spreads, credit spreads, things like this may not necessarily be as incrementally beneficial to portfolios. It might actually bring more volatility to portfolios. So it's just something to consider as this outlook, and more importantly, as the Fed continues to be on this glide path for a while, that we need to be considering as investors in terms of our portfolio construction, focusing on a little bit less volatility that could potentially be emanating from your portfolios.
So that's one potential tactic. But I am interested in your purview as short term.
Sure.
Because as we've been talking about and sort of gesturing at, short term is really tricky right now. I don't envy you trying to figure that. I mean, first of all, how do you define short term? And what do you do short term given that there is so much uncertainty?
For PIMCO, we think about short term as capital preservation. Think of the yield curve as the 0 to 5 year space. So that's relatively short in bond terms. But what's interesting about the current environment is that the short-term environment, rates have gone up over the past few years, but they're now peaking and coming down. From a personal and individual perspective, and even if you're a corporation, there's a unique stratification going on within the rates you can earn in cash now. We've seen, if you go look at your sweep accounts and your individual investment accounts, they could be as low as 5 basis points, close to 0%. And other places with savings deposits, you'll find yourself in the situation that you're not earning near the Fed funds rate of 4.25%. It could be 2 to 3%. So simply staying invested in how you manage your cash And focusing on that is incredibly important to performance these days. So as people still continue to seek safety in this environment, we want to be very cognizant of how they're doing so. And bond yields as a whole can do that. Having some interest rate exposure helps to prevent that left tail risk and create some capital appreciation in owning bonds. But if you're simply going to take the alternative and it be in that wait and see crowd, you might want to see and focus on how you're putting that cash to work.
Not all cash is created equal. And then finally, I want to ask you about international exposure, because on the equity side, we've been having a lot of conversations with people who are looking outside of the U.S. for the first time in a while.
Right.
Is that happening on the fixed income side as well?
It's a very unique environment. And what we're finding ourselves is now that we're past the global financial crisis many years ago, and we're finding ourselves past the COVID crisis, the policy responses from monetary policy entities around the world are very different. So what that ultimately means for investors is there's a divergence in interest rate policies, whether you're looking at the Bank of England, the European ECB, the Australian central banks. These are all central banks that are being much more active in cutting rates than the United States. And as a bond investor with a global outlook, that's creating unique opportunities for relative value trade, something we haven't seen in quite a while. But again, for an investor focused on their portfolio, focused on safety, simply focusing on savings accounts, where those are, and more importantly, optimizing into a shorter bond portfolio can be worth a couple hundred basis points or percentages to their investment. So there are some good places to hide out, and the safety is your concern. Finding some income in bonds is definitely a place to be, at least for the near term, until we get some clarity in terms of the economy and growth.
Jerome, as a bond guy, I expect bond guys to be pretty pessimistic. You don't sound very pessimistic, but I am curious what the biggest risk that you're watching out for is.
Yeah, without a doubt. One of the things that we're finding is that, let's contextualize the conversation here. Growth is still 2% right now. It could be on the upside if certain things happen. It could be on the downside also at the same time. And unless you have a very bullish view and that crystal ball says green, the reality is that outlook is a little bit more clouded. From that perspective, the euphoria that we had in the fourth quarter last year with growth has come off the boil a little bit. Yeah. So don't take me as a bond bearer or a negative person, but we are simply saying there's probably a little bit more volatility out there than the average market participant is suspecting. And in that means simply, let's embrace a portfolio that's a little more diversified at this point in time. And when you put that into context, earning yields and returns of 5 to 7% isn't an outlandish assumption for having some fixed income in your portfolio. That might be very different than having a high-tech stock portfolio, obviously, but that's the context we're thinking about right now, given the outlook, given how policy is going to be evolving, and more importantly, given the uncertainties not just with regard to monetary policy, but also geopolitics. There's a lot of factors out there. So we are cautiously optimistic on the economy. We do think that there's potential for additional rate cuts from the Federal Reserve this year, but the reality is that that's probably evenly balanced, and that outlook could be moved in one direction or another pretty easily over the next 6 months. So for the time being, we need to be focusing on that portfolio construction and that income generation.
Gotcha. Jerome, thank you so much for coming
Great
in.
to be
Really
here.
Appreciate it. Well, U.S. stocks closing higher, the S&P 500 closing at a new record. Investors weighing tariff fears, digesting the latest Fed minutes, all of it equaled an actual gain. Yahoo Finance's Josh Schafer joining us now with the trading day takeaways. Hi, Josh.
Hey, Julie, another record for the S&P 500. So we had Fed minutes out at 2 p.m. today. Those were minutes from the January meeting, and largely they didn't shake the market. We actually saw a little bit of a rally after the minutes came out. So I'm just going to take a look at sort of what we saw in the bond market in the 10-year Treasury yield post those Fed minutes. And really, we actually saw the 10-year move a little bit lower. I don't know if I'm going to make too much out of this move here. There really wasn't a ton of reaction to the minutes.
Yeah.
And I think that's largely, Julie, because what we saw was more of what we've already been hearing from the Fed, right? We're in wait and see mode. They're talking about tariffs. It's part of the outlook here. They're assessing where it's going to go. But I think one thing that was interesting, I spoke to a portfolio manager in fixed income over at BlackRock after the minutes, and what he told me was really the key here is the market bias. As long as the market, or really what the market believes the Fed's bias is. If the market believes the Fed's bias is to cut rather than hike, we're sort of in this comfort zone as far as where the 10-year is going to go and then what that would do for stocks. If we start talking more about hikes, if any of these minutes come out and we feel like that's really a part of the conversation, then maybe that's when we start to see more commentary from the Fed start to shake markets. Feels like we've been pretty steady for a while now.
Or unless we get more inflation data that's
right, yeah, it's
really
inflation
hot,
data,
for
so then what does that mean for the Fed, right? But for now, it's been a little bit steady Eddie.
Yeah, what else we got?
One other takeaway that we have sitting here, The Lag 7.
The Lag 7.
The Lag
Did you
7.
do that or somebody
well,
else? Did you borrow that from
some other
somewhere?
people have done it. I'll give credit to
like
Michael
it.
Hartnett over at Bank of America, who
I like
started the Magnificent 7. He's been calling it the Lag 7 a little bit. But what we have here is a chart from our friend Liz Ann Saunders at Charles Schwab. And what this is looking at, Julie, is ranked returns in the S&P 500. So NVIDIA here was number 2 last year, right? What that means is they were the second best performing stock in the S&P 500 in 2024. What we have on this side is where they rank in 2025.
Oh, wow.
So
Love this.
notice we had 3 Mag 7 in the top 30 in 2025 or 2024. We had 4 in the top 100, 5 in the top 100. Look at where we're at now.
Wow.
You can only find 1 stock in the top 20.
We know what it is.
That's Meta. We've talked a lot about that one. And the rest of them are actually doing pretty remarkably not that well, which I thought sort of stood out to me. And we've been talking about this a lot, that the Mag 7 aren't really leading this rally, but this just sort of stuck out to me as something that's going on.
Well, and it was really interesting just talking to Jerome Schneider of PIMCO, who is a fixed income manager, but talked about in this choppy, uncertain environment, the appeal of getting 5 to 7% returns in fixed income in an environment where it doesn't feel like there's any guarantees at this point, even from the such consistently reliable performers as
but
something
we're
like
at the
Mag
point
7.
where fixed income is a competitive asset, right? As our friend Urin Timmer always says over at Fidelity.
Yeah.
When you get up close to 5% on, say, something like the 10-year, it's a competitive asset with risk assets. So where am I going to put my money? There's other places to put it. Our final one. People are finding some fun stocks to put their money in, Julie, that are going up a lot. So I reached out to S3 Partners to ask about some of the stocks that are often on our trending tickers page. We take a look at, say, Supermicro Computer. Let's go to year to date and let's look at this big gain. That stock's up 97% this year. It's the leader in the S&P 500. But S3 Partners told me it's also one of the most heavily shorted stocks in the market. So a lot of what you're seeing here is just giant short squeezes.
Yep.
Investors need to eventually pay, right? Once they lose on that short, they have to buy the stock. That sends the stock higher. So Supermicro investors have lost over $2 billion on this stock just to start the year. Hims and Hers also.
This is quite a year-to-date chart.
Is up 184% this year. Again, a heavily shorted stock. And at some point, investors get squeezed out of it. And we're seeing quite a bit of that action, especially with some of these stocks that we talk about every day. Why is this stock up 20, 30%? Usually there's a little bit of a short squeeze.
Yeah, I don't think we have the data handy on Celsius, but I would bet that there's
It's certainly
a
moving like one,
amount.
like
well,
one of
at
those
least
amounts
more recently.
on a given day.
We'll see. We'll get some more numbers. Thanks a lot, Josh. Oh, wait, do we have to do that? Or do we just do that with Jared? I don't know. Stick around. Much more Asking for a Trend still to come. Defense Secretary Pete Hegseth has reportedly ordered senior leaders at the Pentagon and throughout the U.S. military to begin cutting 8% from the defense budget in each of the next 5 years. Now, this is according to reporting from the Washington Post that cited a memo in which Hegseth ordered the proposed cuts to be drawn up by February 24th. This has sent ripple effects to some defense names such as Palantir, which we saw fall 10% during the regular session after this report from the Post crossed. It's unclear if any of the proposed cuts would even affect spending from companies like Palantir. We'll be watching that and the other defense names, however. Well, as we are talking about these cuts that are spreading throughout government, even affecting potentially the Pentagon to plan for budget cuts. Again, that's according to the Washington Post. For more, we're going to bring in Patrick Murphy, former congressman and host of Yahoo Finance's Warrior Money podcast. Patrick, good to see you. A lot of rapidly moving developments coming out of Washington, but I did want to get your take on this report that the defense secretary is asking for proposed cuts to be drawn up by the 24th, very short window of time for these proposed cuts. And I guess as someone who has been in government and has been in the military, what is the sort of, how much bloat is there at a place like the Pentagon? Is there in the Defense Department? We see other agencies being eliminated in some cases entirely. How do you think this should be approached for defense?
Yeah, Joe, thanks for having me on. I mean, first, the two biggest federal agencies in the federal government are the Department of Defense and the VA. And in the Department of Defense, we're talking about 8% cuts of the $850 billion a year DOD budget. We're talking about at least a 10, it's crazy, but it's like almost unfortunately, like almost $100 billion, right? It's a lot of money. And it's year after year over the next 5 years. So we have a lot of threats out there that are trying to do our families harm. I mean, we still have folks that are trying to harm Americans. We see terrorist attack all over the world. We see what's going on in the Middle East. We see the aggression with China, who's being more and more aggressive by the day. So we have to be really smart about this. I get it. I'm a fiscal conservative. We got to make sure that we're spending taxpayer dollars wisely. But this was a shock to the system. And also, when you go to the services and say, hey, I want you to plan for an 8% cut every year for the next 5 years. Whew,
yeah,
that's big time.
It's tough. I mean, and we just also heard the Veterans Affairs Administration was going to be laying off 1,000 people. I mean, you talked to a lot of former service members, a lot of current service members, people who were, for your podcast. How are people, are people who are veterans, for example, are they worried right now?
They are, Julie. I mean, our show airs on Fridays. We just had Bob Parsons, who's a Marine Vietnam veteran who started 3 companies, including GoDaddy. He's one of the Forbes most 400 wealthy Americans. There's a lot of my brother and sister veterans that are saying, hey, we just got done the longest wars in American history in Iraq and Afghanistan, over 20 years. The 2 signature injuries are PTSD and TBI, post-traumatic stress disorder and traumatic brain injury. We lost, Julie, over 150,000 veterans to suicide the last 20 years since 9/11. We got to do a better job of making sure we're taking care of our brothers and sister veterans. Listen, they're civic assets. They're doing great things, but there's too many that are falling through the cracks. There are too many who are dying by suicide. So I have some real problems, when we're letting go probationary folks that just joined the VA. A lot of them are veterans. Over 30% of them are veterans that are trying to do what they can to stop our brothers and sisters from taking their own life.
Patrick, thank you very much for your perspective on this. Obviously, something close to your heart, so appreciate it.
Yeah, God bless you. Thanks, Julie.
Thanks. Be sure to scan the QR code below. You can check out Patrick every Friday at 12:30 p.m. Eastern on the Yahoo Finance podcast, Warrior Money. In this past episode, Patrick and his co-host Dan Kuhn sat down with Parlay Finance CEO Alex McLeod and COO Jay Long to discuss how they are revolutionizing small business lending through innovative AI and real-time data.
Joe served in the military. My background was in helping refugees, and together a couple years ago with the Afghanistan evacuation, a lot of folks came from Afghanistan, were evacuated to the US, and a whole community in the veteran community stood up to help them. As part of those people who stood up, the PenFed Foundation helped bring across a group of incredible women, the Afghan female tactical platoon leaders, and helped them integrate into the US, think about their next jobs, their next steps, and a large number of them wanted to start their own businesses. And so the foundation asked us if we could help, and we sat down and we helped these women. And by doing this work, we realized how hard it is for them to get access to capital. You come to the US, you don't have a background or a credit score even, and suddenly you're trying to apply for a loan. As a new business owner, it is so difficult. And so we said, we cannot let this stand. We need to make it easier for small businesses. We need to help them. And that's how we ended up founding Parlay. And we now partner with credit unions and banks across the country to do that and help more small businesses.
For our chart of the day, we're looking at how reliant the market is on big tech. Yahoo Finance's Seana Smith joins us now with a closer look. Less reliant than it was, I guess, maybe?
I was going to say semi-reliant, it's less reliant, and that's the point I'm trying to make here, at least just in terms of as we compare it to last year and how reliant the market was on those handful of companies, specifically the Mag 7. So here's the top contributors to the S&P since the start of the year. And as you can see, yes, Meta and NVIDIA very much in the leadership position there, Meta contributing or accounting for 13% of the S&P's gains since the start of the year. NVIDIA in second place there at 5.7%. But then looking beyond that, some of the other top contributors that we have seen since the start of the year, and that is what I really want to zero in on. When you take a look at JP Morgan, Visa, Eli Lilly, Costco, even Walmart amongst the top contributors here to the S&P since the start of the year. And the reason why this matters is because many investors that we have had on here on Yahoo Finance, strategists, talking about the fact that this is a bullish sign fine here for the company. John Solfas over at Oppenheimer in a recent note just noting the fact that he thinks it's enough here for the current bull market that likely has legs strong enough to climb the proverbial wall of worry through 2025 as we continue to see a broadening of the rally. And this is something that many strategists have been calling for as we started 2025, and we're starting to see that, at least I guess, signs of it come to fruition here earlier on. I also want to point to the fact the performance that we've seen of the S&P 500 and compare that to the equal weight for the S&P here since the start of the year. Very much you're seeing those returns in line with each other, which just speaks to the fact that we're seeing more broader participation beyond big tech. So what does this mean on a global scale, just in terms of those investment opportunities? We put that question to Dave Mazza of Roundhill Investments. He's the CEO there earlier on today in the show, and here's what he had to say about that.
Just do a decomposition of the European market to the US equity market. The sectors are vastly different, much more cyclical, not as much of this excitement from tech. And I still think the idea of US exceptionalism still has some legs and probably will, after we sort of get through this uncertainty, especially on the trade side and tariff side, could continue to be supportive for markets. But investors are rightfully looking for other opportunities.
All right, well, certainly we are seeing investors and more strategists know some of the opportunities that this points to overseas. So yes, big tech still has played a crucial role and critical role in the performance of the S&P since the start of the year. But when you compare it to last year, the Mag 7 actually accounted for more than 50% of the S&P 500's return in 2024. So when you compare the performance here so far of Amazon, Nvidia, and Meta, the top three contributors of the Mag 7 to the S&P 500, the fact that it only counts for 22%, that, of course, then points to some of that broadening that we've been talking about, Julie.
Yes, it does. Shauna, thank you.
Thank you.
That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.